Well, January natural gas prices extended this week's sharp sell-off on Friday, sliding to a 6-week low. The latest U.S. weather forecasts point to warmer than normal conditions across much of the country, a setup that is expected to curb heating demand and has already triggered aggressive long liquidation in natural gas futures. Forecasters noted on Saturday that above-normal temperatures are projected to expand across the western, central, and southern U.S. between December 17 to 21, followed by widespread warmth across the southern half of the country during December 22 to 26. This abrupt shift has quickly erased last week's rally to a near 3-year high. Fundamentals are reflecting the change. Lower 48 gas demand on Friday was estimated at 110.6 billion cubic feet per day, down 3.4% year-over-year, highlighting the immediate impact of weaker, weather-driven consumption. On the supply side, persistently high production continues to weigh on prices. U.S. dry gas output reached 112.5 billion cubic feet per day on Friday, up 7.1% year-over-year. Meanwhile, estimated LNG net flows to U.S. export terminals stood at 18.1 billion cubic feet per day, down 3% week-over-week. Baker Hughes also reported that the number of active U.S. natural gas rigs fell by 2 to 127 in the week ending December 12, easing slightly from the 2-year high of 130 rigs set on November 28. Well, as I pointed out in last week's Outlook, the recent rally aligned almost perfectly with the surge in LNG capacity carried by vessels departing U.S. ports, which reached 138 billion cubic feet a week ago, supported by colder weather forecasts. This week, LNG exports set a new record, with total capacity leaving the U.S. between December 4 and December 10 climbing to 151 billion cubic feet. However, this milestone was largely ignored by the market, as prices continue to slide. That disconnect offers valuable insight into current market priorities. While rising LNG exports provide longer-term support for natural gas prices, short-term price action remains dominated by weather-driven demand. In other words, the weather still calls the shots. If forecasts turn colder again while LNG export volumes hold steady or continue to rise, the conditions would be in place for another price rally. So please comment and subscribe if you'd like me to continue tracking these dynamics. Technically, with warmer forecasts extending through late December and long liquidation still in play, sellers remain in control. While some technical indicators may be signaling oversold conditions, raising the risk of a short covering rally, any bounce must be evaluated carefully. Traders need to distinguish between technical retracements and rallies tied to a meaningful bullish shift in the weather outlook. Continued guessing will be punished, as fundamentals will ultimately prevail. Unless forecasts turn colder or prices find firm support near $3.90, the downside bias remains intact. Meanwhile, on the front-month futures weekly chart, the latest price decline is technically significant. The move lower has been sharp and well-defined, and from a chart perspective, there remains ample downside room before prices reach meaningful support, particularly around the 50 and 200-day moving averages, which have yet to be fully tested. Nevertheless, the probability of a rebound is gradually increasing, driven mainly by technical factors after the recent sharp sell-off. If you enjoyed the video, drop a comment, hit like and consider supporting the channel. It really helps keep things moving, and see you next time.